fight to live, a fight to strive. One day I'll have what I want in life.
Hello and welcome to another video. My name is Exo, and today we're going to be looking at another company review. This time it will be JNJ, or Johnson & Johnson. So we'll first take a look at the company, what it does, how it's broken down, then we'll go into the financial checks. If you've seen the Microsoft stock analysis, it'll basically be like that. So right, let's just not waste any time and get straight into it. So, it operates through three segments: consumer, pharmaceutical and medical. The consumer segment offers baby care products under the Johnson brand, oral care products under the Listerine brand, and beauty products under the Aveeno, I can't pronounce that. I'll put it on screen anyway while I'm looking at it so you can see where I'm at. Clean and Clear, Dr. CL, Labo, Neutrogena and OGX brands. Over-the-counter medicines including that's such a fucking mate, medical device. Yeah, this is not gonna go very well, is it? Acetaminophen, that one. Products under the Tylenol brand, cold flu and allergy products under the Sudafed brand. The bits I highlighted in green, I didn't actually know that Listerine and Sudafed were a part of Johnson & Johnson. They're well-known products, well, for me at least. So, when I saw them, I was quite impressed. Don't know what's happened there. Yeah, allergy products under the Benadryl and Zyrtec brands. Ibuprofen under the Mortin IV brand, and acid reflux products under the Pepcid brand. So as you can see, they have a variety of companies, or not companies, I guess segments and industries they're in, which makes it better for sustainability and volatility. So if we scroll down a bit more, then we see the segment also provides women's health products such as sanitary pads and tampons under the Stay Free and Carefree and OB brands. Wound care products under the adhesive bandages under the Band-Aid brand, and first aid product under the Neosporin. Apparently I can't speak, but hey, with the Band-Aid brand, that was like the big one back in the day. If the person who got that company basically just took off, because that was the first sort of big revolution in medical devices, as having the Band-Aid. So, the pharmaceutical segment offers products in various therapeutic areas including immunology, infectious diseases, neuroscience, oncology, pulmonary, hypertension and cardiovascular and metabolic diseases. So again, with this pandemic going on, JNJ was one of the contenders working on the vaccine for it. So then anything like that, if they do cure things, then normally stock price goes up quite a bit because of that. And then stabilizers, so that's a good thing to have there. The medical device segment provides orthopedic products, generally surgical, surgery, biosurgical and endomechanical, and energy products, electrophysical, that word again, products to treat cardiovascular diseases, and vision care products such as disposable contact lenses and ophthalmic products related to, yeah, man, I'm not KSI, I can't say mural, I can't pronounce these ones, related to cataract and laser refractive surgery. There we go, got some of the words. So, the company markets its products to the general public and retail outlets and distributors, as well as distributes directly to wholesalers, hospitals and healthcare professionals for prescription use. Now, J&J was founded in 1886 and is based in New Brunswick, New Jersey. Okay, so that was a bit of the overlook on the company. Now we'll go into checking the fundamentals a bit and seeing where it's at. So we can see for intrinsic value here, currently at the date of me doing this research, which was 2707 2020, so not too long ago. The current price was 164. The fair value was projected to be $225, so it's 26.9% undervalued. If I just now check, if I just check the price now, trading 212, I'll be able to see what the current price is to give you an actual accurate. I don't think it's changed too much. We had that big market crash recently, correction I guess, just sort everything out a bit. Okay, so if we scroll down to investments and then JNJ. Okay, JNJ is currently $158, so even lower, so even more undervalued now, which is great. So if you're seeing this close, then be a good price to pick up. So it's consistently gone up over the past 58 years with its dividend yield. Its current dividend yield is 2.58%. The free cash flow is good. It's a very slow growing company now because it's been around for so long. The price to earnings ratio is bad, but the profit margin is good, and the number of shares outstanding is good. The current assets to liabilities is good. Price to free cash flow is meh, so just in the middle really. It's a good long-term stock to have. It's less volatile and it's stable, and it did better than the industry. Now for me, like I said before, I work away on ships, so I'm away for months at a time, so having stocks that aren't too volatile is good for me. I can have stability and I don't panic when I'm away because I might not have Wi-Fi, etc. So right, now we'll go a bit deeper. So the PE ratio is derived by dividing the price of a stock by the stock's earnings. Think of this as a way the market price of a stock tells you how much people are willing to pay to own a share, but the PE ratio tells you whether the price accurately reflects the company's earnings potential or its value over time. If a company is trading at say 100 per share, and the company generates $4 per share in annual earnings, the PE ratio of the company's stock would be 25 to 100 divided by 4. That's where 25 comes from. To put it another way, given the company's current earnings, it would take 25 years of accumulated earnings to equal the cost of the investment. In addition to stocks, the PE ratio is calculated for entire stock indexes. For example, the PE ratio of the S&P 500 currently stands at 28.61. Since prices fluctuate constantly, the PE ratio of the stock and the stock indexes never stand still. The PE ratio also changes the company's report earnings, typically on a quarterly basis. So that just tells you a bit of what the PE ratio does, if you didn't already know. Alright, so if we continue now, we can see this shows you the dividend per date, and it shows you how it's increased over the years. So currently it never really had a decrease, it seems. It just constantly went up, and then you can go down, and then it shows you the what's it called, income statement. That's the one, but we can look at this a bit later anyway. So the PEG ratio. Now, what does the PEG ratio tell us? That's the price to earnings growth ratio, by the way. So while a low PE ratio may make a stock look attractive, factoring in the company's growth rate to get the stock's PEG ratio may tell a different story. The lower the PEG ratio, the more the stock may be undervalued. Given its future earnings expectations, adding a company's expected growth into the ratio helps to adjust the results for the company that may have high growth rate and a high PE ratio. The degree to which a PEG ratio results indicates an over or underpriced stock varies by industry and by company type, that is. As a broad rule of thumb, some investors feel that a PEG ratio below 1 is desirable, According to well-known investor Peter Lynch, a company's PE and expected growth should be equal, which denotes a fairly valued company, and supports a PEG ratio of 1. When a company PEG exceeds 1, it is considered overvalued. Earnings, free cash flow, and cash from operations will all grow in line with each other. That's what JNJ is forecasted to do. And now we'll look at analysts' future growth forecast and annual earnings growth. So the company is predicted to be 15.1% versus the industry of 18.6% versus a market of 20.7%. The forecasted annual revenue growth is 4.7% for J&J, 5.9% for the industry, and 10.6% for the market. Now again, like I said, J&J being an established company, it will have trouble growing, but as a dividend investor, you're not too worried about that. If anything, you want it to be at a discount for a longer period of time, then you can add more positions for cheaper. Future return on equity. Future return on equity is considered the return on net assets. Return on equity is considered a measure of the profitability of a corporation in relationship to the stockholders' equity. Whether a return on equity is considered satisfactory will depend on what is normal for the industry or company peers. As a shortcut, investors can consider a return on equity near the long-term average of the S&P 500, 14% as an acceptable ratio, and anything less than 10% as poor. J&J's future return on equity is 31.6%, better than industry at 17%, and is better than the S&P 500, and again fits in with those lines. Revenue has consistently grown in 5 years, however earnings took a drop in 2018 to 2019, have been flat at the start of 2021. Both cash from operations and operating expenses have grown closely together but slowly. So as stated, the current return on equity is 22.8%, better than the 17% of the industry. Now we'll look at what is return on asset and J&J's return on asset. So the return on asset is an indicator of how profitable a company is relative to its total assets. Return on assets gives a manager, investor or analyst an idea as to how efficient a company's management is at using its assets to generate earnings. Return on assets is displayed as a percentage. So the return on asset equals total asset divided by net income, I believe. Higher return on asset indicates more asset efficiency, so again, the higher that is, the better management you have for the business. The return on asset for J&J is good, being equal to the industry at 8.7%. Now we'll look at the financial strength of J&J. So short-term liabilities. J&J's short-term assets of 57.6 billion exceeded short-term liabilities of 38.8 billion. Now for its long-term liabilities, J&J's short-term assets of 57.6 billion do not cover its long-term liabilities of 67.4 billion. However, with J&J being such a large company, it can cover its liabilities quite easily. So the debt level for J&J, debt to equity ratio of 57% is considered high. So the debt to equity is the total liabilities divided by total shareholder equity. The debt to equity ratio compares a company's total liabilities to its shareholders' equity and can be used to evaluate how much leverage a company is using. Higher leverage ratios tend to indicate a company or stock with higher risk to shareholders. However, the debt to equity ratio is difficult to compare across industry groups where ideal amounts of debt will vary. Investors will often modify the debt to equity ratio to focus on long-term debt only because the risk of long-term liabilities are different than for short-term debt and payables. So a bad thing about J&J is its debt to equity ratio has increased from 28.3% to 57% over 5 years. However, the debt is well covered by operating cash flow of 58.7%. J&J interest payments on its debt are well covered by its EBIT of 221.3x coverage. And now we'll look at its dividends. which, as for me, is one of the key things. So it has a current dividend yield of 2.43%, which is higher than the bottom 25% of dividend payers. It's not as high as the top 25% of dividend payers at 3.8%. However, this will allow for more stable dividend and is close to the industry average of 2.8%. And with its lower dividend yield, it could then put more money back into the business and grow it a bit, so keep it moving along with me. So its payout ratio is a bit high, of 72.2%, but it's alright, to be honest. And its dividends are covered by its earnings very well, so there's still room to grow. Ideally, I'd like to see that lower, which in its future dividend coverage in 3 years, it's forecasted to be well covered by its earnings at 40.6% of a payout ratio. So if it does that, then I'll be happier, but as I said, it's not too worried. So we did have an ex-dividend date for February 22nd of 2021, and the payout will be in March 2021. So I think that just came through already. Today's the 10th. Yep. Okay. Now we'll look at stability and growth. So, its dividend per share has constantly grown from 2011 to now. The dividend yield suffered and has been up and down, currently lower than the dividend per share. Earnings per share took a big hit in 2018 to 2019. I'll show you, I need to look into that, and then I'll probably put it in the video of what happened there. Future dividend coverage, the dividend paid looks like it will drop to a payout of 41% by 2024, retaining more earnings to I assume grow the company. That's its options. Okay, so now we'll take a look at its income statement and cash flow, and then we should be good with the video. Alright, so as you can see here, we've got the income statement up in front of us. This is on Seeking Alpha, so if you need a good website to go to find financial and do some company analysis yourself, feel free to go. It's free to use. There is a paid subscription, but that just allows you to unlock some other things. But as the data we've got here, we can go from 2017 to current, so that's what we're going to be analysing. Notice up in here it says in millions of USD except per share item, so all these numbers here are in millions. So with these companies we're always using big numbers as always, so let's just get right into it. So we'll take a look at the revenue section. So we want to see a consistent revenue growth when we're looking at a company. That shows that is a growing company. It's not looking to go stale anytime soon, and you can have a bit more faith in the company that way. And then we'll look at gross profit in a minute. So 2017, we can see it was at 71890, and then we can see it's gone up and up and up and then up a little bit, and then it's just sort of been, that's the trailing 12 months, so that's this bit really. So it's going up. Here we weren't going to increase too much because of the pandemic, so everything was a bit slower, and it will start sort of growing a bit slower anyway as the time goes on. The good thing about JNJ is because they're in the medical field, they've always got new things that they're bringing out, new vaccines, new medical devices, and that's an industry that's never going away, to be honest. Like, until we turn to fucking cyborgs or robots, you're always going to need healthcare, so I'm happy with these numbers here. So the total revenue we can have a look at as well, and as you can see, increase, 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 a little bit of an increase there, but again, same reasons there. It's gross profit, that's a good one to know, and we can see that it's increased, increased, now it decreased here in 2019, so they might have, the gross profit, they could have then reinvested that back into the business. So that might have been what's gone on here. Maybe they put a bit of money back in. No, this did increase even. It's this one that decreased. Okay, so that makes more sense anyway. That is this would just be the pandemic then. Yeah. Scratch what this bit was about. Yep. Alright, so this was just pandemic, so nothing to really worry about there. everything took a dip, so that's all good. It's getting you worried about nothing there. Alright. So the operating income decreased there, increased, decreased there, decreased there. So this would have been where they just shut down a few more of their things. They weren't running as much because of the pandemic, everyone working from home or such. Or with JNJ, I don't imagine they'd have been working from home. They'd probably have a few less people in certain things, but the people doing the research on the vaccine, that have been full throttle. So some of their segments would have took a hit, some of them would have been up. So that's operating income here. Doesn't really, some sectors shut down, that's why it'll be lower here. But it's been pretty stable, up and down, fluctuating a bit, so I'm quite happy with that. So then we'll look down to this section. A lot of these I don't look up too much. I'm not going to give you anything on these because I don't understand fully myself, so it'll be pointless. I'm just going to be honest and tell you I don't know what the fuck these things are yet. I'm not sure if they're too necessary or not. But net income is one that I do look at, because net income is sort of the take home pay. That's what you get in the pocket. So as we can see, that did something there in 2017. That's a bit interesting, so I might have to look at that. So decreased massively there, and then had a nice bit there, and sort of, okay, so it's been decreasing a bit slowly over time actually. So this is not ideal. You would want to see this going up. The net income, you have two options, whether you can either reinvest it back into your business, or you can pay as dividends. So as long as it doesn't drop too much, then we should still be alright. Maybe that's with the high payout of 72, maybe that's what that's about. So that's when you have to look into things like that. So when you see a irregularity, then you start looking at things. So I'm just giving you the tools to know what to do, really. We can have a look at all these revenue per shares and whatnot. So you can see the revenue per share has increased over time. Yeah, that took a big dip there, but that's in line with the net income one as well, and then it recovered there, and then it's been a bit sort of slower there. So that's in line again. Normalized. There you go. Normalized earnings per share. That's a bit more in line. Still a bit of dip there, but not as bad. So that's closer. So the dividend per share, we can have a look at that to see how stable that's been. And as a dividend investor, I want a steady growth, so I'm going to be looking for that here. So 2017, growth, then there's growth, more growth, and a growth. So that's great to see from a dividend investor. If this has been dropping, then that gives you less support in that company. You don't want to invest a load of money into a company that's just going to slash its dividend or decrease it a lot. Disney just cut their dividend. A lot of people are hoping that gets brought back, but if it doesn't, then I know there's a few people there with a lot of pain. Okay, so here we can see that's what's happened here. That's one of the irregularities here. So we've had a payout ratio of 52.12% there, and then in 2017, where everything dropped, and the net income or everything, they've had a 687% payout ratio. I have no idea why. So they've literally paid up all their money in dividends. I don't know if they tried to save their company in this year. That is that's a high payout ratio. Or if, I don't know if this would be a mistake. I've not seen any mistakes before, but it's possible. But then it goes back to 62, 65, 71. So the payout ratio, it's been increasing, which is not the best. But if it doesn't go much higher than this, and it's forecast to go back down, as we saw earlier. So hopefully we'll be fine. At the end of the day, all the stock market is making informative sort of guesses, really. You can back it by data, but at the end of the day, no one knows what the stock market's going to do. I don't know. This is not financial advice. I do this for fun and for my own research, so that's the preface I've got to get out of the way. YouTube likes that. Okay, so that's all that bit done. Then now we'll take a look at the balance sheet. So I'll be right back. Alright, so we're on the balance sheet now. We don't have to look too in depth in this because we've went through the kind of the balance sheet when we looked at the liabilities and the assets. That's all this basically is. So you can see through here, cash and equivalents, and that's fluctuated a bit there. So a high point as of 2020 and then dip right down there. These aren't too much of an issue, these cash short-term investments. This cash flow that will look like we'll look at, and that'll be the most important thing for a business. So we'll just skip to current assets, really. That's what we need to know. The current assets, total assets, and then all these assets and liabilities. Alright, so we should look at total assets here, current assets. We can see that the assets have decreased there, increased a bit there to above the 2019 level. Okay, so this don't go back very far at all. Is this in quarterly, March, June? Hold up. No, it's in quarterly. Let's get this to annual. If it wants to load. Come on. There we go. There's a bit more to go on. Alright, just go back down here again. Alright, so 2017 was high, and then we had a drop there, bit of an increase, drop there, bit of an increase. So there's been a bit an up and down there, really. You can use sort of this periodized way of doing it. So you can then use some years where you grow the company a bit, and then some years where you take the foot off the pedal. And then this way allows you to sort of keep doing both the dividend and the growth way. It's a bit of a weird way of doing it, but you can do it. Because if they've got more assets in this year, but then less in this, they're not getting rid of any of their like business ideas, really. Like, they've still got all their consumer segments that's not really changed. So technically the total things they have hasn't changed, but yeah, that one's a bit of a weird one. You have to sort of research more into that. And then we'll look down here, so the total assets. See, this is sort of the total assets, which is sort of more important than the current assets. Because again, like I said, it doesn't really change the business, they don't sell much. As you can see here, it's increased here, where it decreased here. So just because they do something in the short term doesn't mean it affects the business in the long term. That's what I was trying to get through. So it's increased there, little dip there, but then up here it went increase, so showing you again, and then increase there, increase again. So there's been steady increases, and then some plateau along these 3 years, and then like quite a big jump here. So in this is 2021, so this will be vaccine stuff, because I know JNJ are trying to push all their vaccines now at the start of 2021 for this pandemic. Alright, let's have a look at the total current liabilities. Might as well scroll down and we can compare it as we go then. So the total current liabilities had an increase there, and that liabilities had an increase there. Then we've had an increase, a decrease here, increase here, increase here, increase here, and increase here. Okay, so the liabilities are increasing, but again, we went over, it has enough cash flow and is well covered by its operating expenses and all that. So it's still not really a problem, but it's just good to get an idea of how it's been over the years. If it's just rose dramatically, if there's big spikes and falls, that could mean that the company's management isn't very good, and again would not be very good as a dividend stable investor. If they're going up and down all over the place, then you can't have confidence in anything they're doing. If they keep it around, it's bound to go up and down. You can never have year-over-year growth, and everyone tells you can. It's not been the stock market long enough. So that's what that's about there. Okay. Is there anything else we need to know about on here, really? Total debt. guess, yeah, could do total debt. But again, we've looked at the debt value and it's been good. Here's some book values here, and you can cross-reference this with the book values of the company that's supposed to be there. Alright, we're just looking at cash flow, and then we will be able to wrap everything up. And then actually no, there is one more thing I want to show you. Okay, so cash flow here, you can see the net income again. Big dip there, we know why, we found that out. And then recover, little dip, little dip. So the cash from operations, there you go, that's increase. So that's what's covering all the debt. That hasn't actually dipped, so that's good. Good management there. Net change in cash, this is a nice one to have. Looks like they don't hold much cash at all. Fuck me. Jesus. Oh well. Yeah, it's not too... Again, depends. A company can use a lot of different ways to pay off their debts. Some use a boatload of cash sitting in a pile. I know Berkshire Hathaway has a ton of cash just sitting there. So if anything ever comes up, they can pay it down instantly. Their cash position is a lot bigger than their investing position, and they have billions in, so depends how you like to do it, really. Okay, so I'll go the next thing up, and then I'll show you that, and then we'll be done even. Alright, I just wanted to touch over again some of the sort of products that JNJ does, and more details about the actual company itself. It's fine looking through financials, but I think in nowadays markets, everyone's so caught up in analysing stocks in numbers and stuff like that. Elon Musk recently stated that people sort of forgot about the business itself, right? Like what they sell, and just care about numbers. If a company's got a product, it'll do well, the rest will follow. Like, if you don't have a good product, your business will fail. If you have a good product, your business will likely succeed. So that's what we're going to look at now, is J&J got good products, and is it in good sectors? So for a sector, it's diversified into different categories. So here we can see it's got pharmaceutical products, it has medical devices, and it has consumer healthcare products. So we'll look into each individual bit. So if we start with skincare products, you can see it has Neutrogena for more than 60 years, so it's been around for a long time. It's available in 70 different countries, so diversified there. Aviona, again 22 countries. It sells a variety of different things. It's been around since 1945. So this is having these established products. This is what will generate the business money. If you don't know about the basics of the business, how it makes its money, this is it. Looking at all the financials will not save you at all. So when I looked through this, I could see that all these products have been around for a while. All of them have been tried and tested. It goes self-care products, so you got some Tylenol, so awesome, all of these. And again, like I said earlier, unless we turn into all fucking robots, we're all going to need healthcare products, we're all going to need pills for allergies or whatnot. Benadryl, I'm pretty sure this is a well-known one in the UK. I've seen it quite a lot, I'm pretty sure. And then Nicorette is a new one that I didn't know they did. So this is a good one with these people trying to quit smoking. And then essential healthcare products, got Listerine. Now for me, Listerine, I hate the stuff. I cannot stand it. It tastes disgusting. So that one is like, it's like the most well-known mouthwash. But then if I'm thinking of it from a consumer standpoint, I hate the shit. So it's like, but then other people use it. So that's when you got to take your own bias out of it. You learn that if you do academic writing and stuff like that, you got to learn to take the bias out. And the Band-Aid brand, this is the thing that excelled J&J back in the day. This was the #1 thing. Now they've got you got like strips you can put on each side of the cut, and then they've got these straps you can pull through. I don't know if J&J will ever pick that up, but if they did, that'll be a good one. That'll be the next revolutionary sort of plaster, and they're a lot stronger than stitches as well. So if they start selling them, it'd be a good one. This is the typical baby one. I had this when I was younger, so this is never gonna go. This one's actually a new one, but I've seen a lot of people use this. I reckon this will keep going. Haven't heard of this one, but I don't really use moisturisers, so that'll be why. Alright, so as you can see, it still has a lot of products there. So we'll have a look at medical devices. It's so diversified, J&J. That's why I have so much faith in this company. It just knows how to diversify into different areas. So you've got joint reconstruction, trauma, spine, sports medicine. Sports medicine is one that I could see going up quite a lot. And then power tools. You find these a lot in sport as well, so whether that's where they use them as well, I don't know. Cranio Max. Yeah. If you can say this word, kudos to you. Biomaterials. So they're in so many different things. They also do, in their surgery section, I believe is like sort of plastic surgery. But we'll look into that in a minute. There you go. Even more products here. They're in so many things. Here's the wound closure bits. I'm not sure if this is one I was on about, but they do stuff like that. There you go. And there's sort of the plastic surgery thing. That's not as big in the UK. If this was, oh, okay, it's made in the US. But yeah, the US has a big thing about that. Not so much the UK. But as you can see, J&J is just a powerhouse in terms of where it's going, and it's trying to get these more complex things out the way as well. If it can crack these, then that'll be a major win for the company. And the COVID thing they're working on in a minute, that's in their infectious diseases tab. There you go. If you need to stop and read any of this at any point, or you can just go on the J&J website. I like to go on the J&J website because there's a lot of opinions on the web, so if you just go straight to the source. Alright, so as you've seen there, it's very diverse. That's basically what I wanted to show you there. Alright, so we'll jump back to the video and then we'll sign off. So I hope you enjoyed this video on J&J company analysis. Don't forget to check out all the links in the description, especially the Train 2121. Deposit £1 with that link and get a free share. There's some merch down below. Check out my social medias. Like, comment, subscribe, all that good stuff. And I'll see you in the next video. Peace out.
On it, and they buy 100,000 shares. That's what I want you to do. You be ferocious. You be relentless. You be telephone fucking terrorist. Now let's knock this motherfucker out of the park.
Tell me pretty lies, look me in the face. Tell me that you love me, even if it's fake.